Mic check, mic check. Yes, I can hear you. Um, Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it, and we'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. All right, so um, as we close out the week here, I think this is a pretty fitting um way to close out the week. Something nice, simple, straight to the point. Tonight we're going to be talking about essentially the role of valuation multiples, but I'm gonna speak about valuation multiples from I'm gonna speak about valuation multiples from a different perspective here, right? I'm gonna talk about the three top use cases that you will find for valuation multiples as an investor. Right now, for the most part, one second here. Yeah, so for the most part, you when people first bump into the stock market, right? They learn that um, a low price to earnings means a company's cheap or they learn things like, if a stock is trading at at a low price, that a stock is cheap. And, I've encountered a lot of, people over the years that would, you know, essentially go about defining whether they wanted to invest in a company in this way. And, you know, that's a general idea. It it works in some cases because, well, I mean, at the end of the day, if you have um at the end of the day, if you have some type of if there's some type of like how do I put it? If you have a market that anybody can invest and the market is in itself in general is cheap, that works sometimes, and I say sometimes, but it's not going to work all the time because, when it's all said and done, a lot of times a low valuation multiple is telling you something else. Right? It's not actually telling you that you're dealing with a it's not actually telling you that you're dealing with a cheap stock. Right? It could be telling you that the company's in distress. You know, it could be telling you that the market doesn't expect any growth. There's a lot of things that could be going on. It could be the entire industry that you're looking at that's experiencing this type of valuation disconnect, is kind of the way to word it here. Right. And so I prepared a few slides here. I'm going to let me open this up real quick. 1 second. Same as last time. We're not gonna have like a ton of slides to go over here. All right. Not gonna have like a crap ton of slides. Hold on 1 second here. Why did it open in that tab? 1 second, it opened in the wrong tab. Let's try this. All right, there we go. So yeah, so like I said, so in many cases, this ends up being the reason why a lot of people don't end up having the experience that they want out of the market. They start off with these more like, I guess easy to accept ideas. Um, 1 second, guys. Savannah. So Savannah's back there up to no good. She's distracting me. Um, so yeah, so as I was saying, a lot of people fall under these like these basic principles, and they're easy to believe, right? If I said a stock was trading at a PE of 1, somebody might think that that's the best. Somebody might think that's the best deal ever on earth, right? Because I mean, if it's a PE of 1, I mean that must be cheap, right? For those that don't know what a price to earnings is, what a PE ratio is, right? Let's start talking about valuation multiples from this perspective to start off with. So when it comes down to valuation multiples and PE ratios, now essentially, when it's all said and done, a a company has a certain amount of earnings, sales, whatever whatever they may bring to the table. We call it economic benefits. Right, that's what we call it. We call it economic benefits. They may bring that to the table. Right now, these economic benefits that we that we find from a company, we have to decide how much we're willing to pay for that. And those um oftentimes those valuation multiples end up being far too much in the you know in the grand scheme of things. It's too heavy of a price to pay, but it's not that easy to see in the beginning. All right. So let's take a look at this first slide here. So this is one of the top use cases for valuation multiples. All right. It's called relative valuation screening. So as I said, we have a company. They're in a specific industry. We have to figure out what the stock is worth. When it comes down to relative valuation screening, um, this allows you to rank the stock among its peer group. All right. But I have four things listed here. Two of them are my favorite. Now each of these three specific types of use cases I'm going to be talking about tonight. These are my three favorites to use. So tonight we're going from that perspective. I'm really showing you here's what I would go for every time. And some of these you guys have heard me speak about. You've heard me speak of all of them, but these first two in specific are going to be ones you've heard me speak about mainly in passing as I'm analyzing companies, but haven't really spoken much about it. As far as like teaching it outright. And so on this list here, the anomaly detection and the pair benchmarking, right? Those become my favorite points when it comes down to relative valuation. Um, one of the reasons why these are two of my favorites here when it comes down to relative valuation is because you can benchmark a stock versus itself or versus its industry. And in this particular case, we're going to focus on the industry itself. Right now, if you have a high quality asset where the current price has shifted away from the fundamental value, then that's a good look. So sorry about that, guys. So basically, you're looking to locate high quality assets where the price is essentially showing a divergence, right? Um, One of the key ways of finding that we're going to talk about in a second. Um, but then we have peer benchmarking. And so this is directly evaluating a target company against, and notice it says clones, right? Basically, we're saying it's the exact same type of company. So, but you want a group of companies. I try not to go just one or two companies. I try to have you know um, at least three competitors or better, and you can start to go that way. Now, if you can't find companies that are running the exact same type of business, right? And for the record, you can have one versus the other. Like you could have I know we had what was that name of that company? I know we had Alton. There was another one on the market that was doing beauty care as well. I can't remember the name of them. But yes, you can put those two next to each other, and say, well, which company is better? And then imagine if the better company had the lower valuations out of the two, then you kind of automatically know you're getting a deal, right? Um, let's slide up. Let's slide down here a little bit. So this is what we call, the broken multiple, or the anomaly, right? So now anomalies occur when a company's fundamental performance improves while its valuation multiples contract. Now we've been seeing one recently, right? We've been having a lot of conversations about Adobe, right? Now this is not to say that we know for a fact when all the multiple contraction will stop. But in the in the onset of things, let's take a quick glance at Adobe here. Let's um let's, let's go here. Okay. All right. So if I pull up the stock over the past year, it's been going in this direction. All right. But let's say I was to go take a look at the revenue. This direction the revenue's going. Right. So we have a disconnect here. As the company makes more and more and more and more money, the market is paying less and less and less. Right. So that's what this is. That's what we're discussing here. Right. So again, there's no way for me to say to you that today is the day Adobe's going to stop falling. What I can say to you is we have an anomaly here. We have a disconnect. Right. Um, and so as an investor, you have to decide for yourself whether or not that disconnect is meaningful to you. Is this a company that you truly want to invest in? Now, you can see it says expanding return on equity versus falling multiples as well. Now, there's the other part of this where a company has um, a high price to book, right? But their return on invested capital is actually falling. So rising valuation multiples, but falling returns. Okay. These are what's called valuation pairing. In essence, we have a way of pairing valuations up with like other metrics to determine if it's good or not. Now, um, this suggests that the market thinks that this is temporary. Let's be very carefully. So the high valuation multiples plus the low return on invested capital says the market believes this low return on invested capital is temporary. right? They believe that in the end, this story is going to play out. Again, yet again, where this is you as an investor who makes a decision and says, you know what, I do believe this is going to work out, or I don't, right? Um, Now, the opposite case here would be if the company had extremely low valuations, okay, and a low return as well. So that's what we call valuation versus distress. All right, and we'll talk about that in a few. I think I have a slide specifically for that. I think I have a slide specifically for that. So this is your pair benchmarking here, and this is kind of what this looks like. So I can take each one of these components, right, and I can focus on them. But let's just focus on the EV to EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EV stands for enterprise value, which is basically a fancy way of saying what's the company actually worth if I factor in the debt that they're holding. Okay. Um, so if we have this situation here where we have a company leading their peers in and this is just an example. It's not meant to be, right? Let's say they're leading their peers in you know, in return in generating returns, right? And generating profits, leading their peers in growth. But when you look at the EV to EBITDA, which is your multiple, like I said, so basically it's about how much am I paying for what the company's offering, right? If they're offering me $1 in earnings, how much am I going to pay for that? In this particular case, they're saying I'm paying $8 for every $1 in enterprise value right here. Well, here's the issue with that. The issue is that when it's all said and done, I'm paying more for this company, and this company, despite each and every one of these companies making less money and seeing less growth than this company. So, right, fork in the road again to invest or not to invest. Now, you're going to need to do your due diligence. You're going to need to dig deeper into companies and figure out, you know, what's the reality for the company right now, right? That's the moment where you step outside of the numbers and start digging into, the nuances, right? Um, what's actually happening with the company is what you truly want to know. Um, Let me put this link at the top here. I forgot to pop this up here. For those that are on Clubhouse right now, I am showing a presentation. If you want to come on over right now, you can click the link at the top of the room and hit watch us on Twitch. All right. I thought the link was up there this whole time. But yeah, you can click the link at the top of the room on Clubhouse and hit watch us on Twitch and come on over. All right. We still got good much more to go. It was not many slides here, but we're going to be doing some work. We're putting some work here. All right. The second use case is one that you guys know that I utilize on a regular basis. Um, so this is the style segmentation. All right. This is where I take valuation multiples and I lead with one assumption, and this is something that Peter Lynch talked about a lot. Um, not in this fashion, but it's something that he looks at, like, what type of company am I investing in? So we would look at the entire market, an entire segment of stocks in a certain way, right? In this way, we would look at them and say, Um, each of these companies is priced a specific way for a specific reason, or they have specific characteristics that lead to them being priced that way. Um, and you're looking for the ones that really should be technically in that next basket up, pretty much, right? So, for example, right? Um, when we look at the if I have 100 stocks, let's say I have 99. We're gonna keep it simple, right? I have 99 stocks, right? I sort them out. I sort them out by valuation multiples, lowest to highest, right? So what may be perceived as the best valuations should be in the first bucket. Okay, it should be in the first bucket. Um, what are believed to be the highest multiples should be in the last bucket, or the highest bucket. And then, there's the companies that sit in between. Now, when it's all said and done, imagine I have 99 companies and I sort them out. Lowest lowest valuation multiples on the first page, highest on the last page. So now imagine I took 33 companies and I bunched them up into here, into the value basket. I took another 33, right, or the next 33 up, right? So the first 33 ends up in the value bucket. The next 33 ends up in the GARP. This is growth at a reasonable price. And then the last 33 ends up in the growth bucket. Now, I'm gonna teach you guys a little trick here, because here's what you're really saying. What I'm really saying is I'm willing to bet my bottom dollar that there's some company in this value bucket that probably should be where? In this growth at a reasonable price bucket. Somehow, some way, we sold that stock just a little too much. We got a little carried away. And instead of stopping here, we continued to sell the stock lands here. That's what's really happening. And so we dig into this basket, into this bucket, trying to find stocks that truly belong here. Okay? That's what it's really all about. So, and this use case for valuation multiples is by far, this one is my favorite. When I was talking about these two up here, these are my favorites in the relative valuation process. Okay? But um, when it's all said and done, I'm not like I'm not saying those are my favorites overall. This is my favorite overall. Why? Because look at what I just said. It allows me to live in a premise where other styles of using valuation multiples really don't, right? There's no core philosophies behind most of the premise that these other these other I meant to say styles are all about, right? So yes, I have these, the concept behind it, and there's some foundational philosophies there. Like I said, a company that's growing very slowly but has high valuations, you want to be cautious there. A company that's growing very slowly and also has low valuations, right? Well, that's a quality versus the stress you know um type of situation, right? So now here, this allows us to really just sit back and be peaceful in our work, because there's not a lot of there's not a lot of, how do I put it, this isn't a very high stress way of handling it. This takes all of the stress out of using valuation multiples. Okay, that's why I love it. You can keep it real simple here. Now, as I said, I'm looking in this bucket to find stocks that belong in this bucket, but guess what? I'm looking in this bucket to find stocks that probably belong where? In this one. So some of these stocks in the bucket where we're getting growth at a reasonable price, we're getting some real growth at a reasonable price. Y'all understand what I'm saying? We're getting some real growth at a reasonable price. It becomes, you know, uh, 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 a way of handling yourself in the market where you're really expecting a point A to point B scenario, right? I find a stock that the market's mispriced. I invest in that company. The company then, over the time period that I'm invested, the market recognizes their mistake, and then you know, um, they aim to actually fix that mistake, right? Um, their goal is to actually their goal is to actually now take advantage of the mispricing just as you did. But if you could find the mispricing before anybody else, you'd be good to go. 1 second, guys. All right. Um, um, now this is the same idea here, right? This is your example. So your price to free cash flow right here, right? You're saying down here we have all the companies. Let's just imagine we have all the companies whose price to free cash flow is below 12. Okay. Let's say in this basket we have all the companies whose price to free cash flow is 12 to 22. And in this basket we have all the companies whose um, price to free cash flow is 22 or better. All right. So trades at extreme discounts on this side. Um, high capital efficiency potential, but currently neglected by institutional capital. Requires screening for structural moats. Meaning you need to find out if this is actually a company who has a competitive advantage or no. All right. In this basket here, these companies are showing compound operational growth without multiple expansion, or they focus on return metrics like return on equity, matching or exceeding the multiple, right? So you have a more balanced risk to reward profile here, right? On the other side, you have a higher risk of multiple contraction, but also you have a high likelihood that these companies may be growing their business at a very, very high rate. Okay. As you can see here, valuation requires analyzing long-term cash reinvestment rates. So how much money is the company driving back into the business? Right. We were looking at Tesla a second ago. I looked at Tesla. So after all these years, Tesla's retained about $40 billion in earnings, right? Over the trillions of dollars that the stock trades at. Um, And I'm going to teach you guys a little bit about analyzing what they call the growth at a reasonable, present value of growth opportunities. I'm going to show you guys how to analyze that, probably in one of these sessions, but keeping it light for the beginning stages here. All right. So in class tonight, we're going to highlight how starting, how this strips away the accrual accounting distortions. Okay. So this is going to be one of the exercises we're doing tonight. Okay. Now, last but not least, as I mentioned, we said we're going to come back around to this, right? So the valuation versus the stress. So not every low multiple is a value opportunity. All right. When the market is pricing a company at a single digit multiple, it often signals an anticipation of fundamental distress, not a mispricing. All right. In fact, Benjamin Graham, the guy in value investing, um, he used to say a price to earnings of less than 8.5 or 8.5 or lower is a company that's priced for no growth. Right? Nowadays because we you know we tend to have a lot more growth stories in the market. I think that number is probably closer to 8, maybe even 7.5, but I don't want to push it. You know, um, so want to be identifying the signals here. Like I said, you can have a divergence, a valuation divergence. So your debt coverage ratios are falling, but your multiples are compressing. All right. So, in other words, imagine if you've just been paying off your debt, right? Like crazy. You've been paying it off early. So more and more of the money that you're making is going to be driven back into the business, but the market doesn't see that yet, right? They don't see that yet. All they see is like that stock plummeting, right? Um, so like I said, so this is what we're going to be talking about tonight, and then we're gonna actually go the route of, once we've decided what we want to do, we're gonna go the route of digging deeper into the discount factor. So tonight three simple steps. Okay, 3 simple steps we're gonna do tonight. Step one, we're going to utilize a screener and a set valuation strategy to determine what basket of stocks we want to look at. Okay. Step two, we're going to run them through the Oracle X to see, how quality of the company may be, and also to discuss what valuations are looking like next to returns. And then step number three, we're going to do some practicing on the discount side. All right. I want you guys to practice discounting. All right. So let's start off with our screener here. Let's go. Let's reset all the filters. All right. Let's go to the valuations tab. But actually, well, let's go to the fundamentals tab first. When it's all said and done, you guys learned this. I think this might have been almost day one. Screen away the weak companies first. So we need a profitable company. All right. We want to know that their business is growing. We want to know that their earnings are growing as well. Okay. And then last but not least, I like to go with the price to free cash flow. Tonight I'm actually going to be a little more lenient. I'm going to go with price to cash flow below 45. All right. So I end up with 39 pages, which we're going to just count that as being 40 pretty much. All right. Going to count that as being um, about 40 pages, pretty much is what we're going to count it as. All right. So pretty much we're going to split this into 4 groups. So over here, we split it into 3 because we had 99 companies, right? Hypothetically. Now here in the real world, we have 775 companies. That's the one thing to pay attention to. You're going to have some companies in front of you, right? So in reality, it's about 40 pages. So I'm going to go, what we're going to do is going to go with um, four buckets, right? And so I'm going to have the first 10. So pages 1 through 10, these guys right here, we're not even going to touch them, right? No investments coming for them from us. Starting at page 11, that's where we start to see names that we're looking for. Okay. And then that's going to work all the way out to 20, to page 20, where on that side you'll have your what we'll consider to be, you know, your growth names. Okay. Um, so in this particular case, if you wanted to really kind of have both sides working together, well, then I have pages 11 through 20. All right. So that means 16 through. No, hold on. Wait. So I meant to say 11 through 30. I meant to say, all right. We have 16 through 20, and then 21 through 25. So 16 through 25 is going to be smack in the middle of this group. Whatever you find smack in the middle of the group is always what they call growth at a reasonable price. Okay? I repeat, whatever you find in the middle of the group is always what they call growth at a reasonable price. Okay? Now, the whole concept of growth at a reasonable price is relatively simple. Um, we're pretty much just saying we're paying less for the growth than we should be paying if we're right about the value of the company. All right. So first we need to do what? Sort them out by price to free cash flow. So I got price to free cash flow right here. Go order by price to free cash flow. All right. And then we go in ascending order. Now, once they're in ascending order, um, like I said, so the first 10 here is a no-no. So this means price to free cash flow. That's about 10, 10.4 and back. It's really just a no for us there. So then we have 11 through 15, like I said, and then 16 through 20. So anywhere from 11 to 20. Um, I'm sorry. I'm sorry, 16 through 25, I meant to say. All right, those are going to be the ones that we're looking for. All right, so here we are. Now, you have a few ways that you can deal with this, right? So I can take a look at each of these companies, and then I can actually go and search them up in their own industry if I wanted to. So let's say, for example, I got Smithfield Foods in the packaged foods industry. Pop them open in a new tab here. Remember, one of our ways of doing this analysis was to do what? It was to do a benchmark analysis, right? Well, best to benchmark packaged foods versus packaged foods. I have 63 companies here, and I can do the same thing in packaged foods that I just did over there, right? I can say I only want the profitable companies, whose earnings are growing, um, and whose business is growing. All right. So I'm down to 8 companies right now. If I was to ask for a low price to free cash flow, what would happen? Let's find out. Okay, so I still have that same 8. So, um, what I want to do now is find out, does this company really sit in that area that I want it to? Let's see here. Let's go to sort by price of free cash flow, ascending order. Okay. All right. Here's SFD right there. Okay. So you can see that they're kind of like middle of the pack. They're like middle of the pack, slightly over the median here. Right. Let's see here. Now you can see the return on invested capital for this particular company is the highest. I'm sorry, no, no, I'm sorry, no, 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 no. It is the fourth highest right here. It's the fourth highest of this particular group. See? 1, 2, 3, 4. Yes. So it's the fourth highest of the group. So they're like middle of the pack for return on invested capital, right? And they're like middle of the pack for valuations. So I mean, I could come to the conclusion that I'm kind of dealing with a middle of the pack company here, and that may be one of the reasons why they're trading where they are. Right? I can, it's a simple but mindful way of drawing some initial conclusions. All right. Now, let's go back over here real quick. Okay. SFD. Okay. The company does have a positive outlook. Um, so you can see right here, the return on invested capital is fine. All right. Their sales growth, their earnings growth is pretty much non-existent. The price to book is, for me, 1.5 is, I could deal with it. But the reality here is this company still presents us with a bit of a challenge here. Right now, you can see right now at the gate, this is their street value. This is their, true value right now based on our calculations. So let's just focus on the street real quick. Um, we're gonna do some calculations here, and let's see if we can dig back into what we discussed the other night. All right, but I'm gonna be doing this. Um, I'm gonna be doing this just as things are playing out here. As we discuss it, right? So I'm going to be going through each particular company as we get there. Similar process, not always the same process. You know, like you may have a few things you need to know about Smithfield that you may have already known about Post, right? The cereal company there. All right. So now, in order to calculate the valuations here, one of the first things I need is the company's beta. Look at this right here. This company, all right, may have a negative beta. I'm going to double check on this. Let's double check on this. Okay, so yeah, I believe they have a negative beta because right here it says /NA. All right. So this is telling me that in a lot of cases, this company goes in the opposite direction of the market. So here they go in 2025, all the way through the end there. So performance-wise, it's been a lackluster performance. This is the maximum return of the company. So this is coming from so this is a relatively new company, I believe. So yeah, the IPO date was January 28th, 2025. Okay, so it's a relatively new company. So now I'm tasked with figuring out how much I should be paying for it. Now, given that it's a relatively new company, there does not mean that they were just founded now, right? They were founded in 1936, as you can see here. All right, they're founded in 1936. So we may not give them the same leeway as if to say gotcha, Dave. Dave said it's a spinoff, right? Now, either way, in this particular case here, we need to definitely. I think you were trying to say that spinoffs have outperformed the SPY by 10% since 1980. I'm not sure if that's what you meant to say. What was you trying to say there? Um, I try not to go I try not to go that route for something like this because no matter what, I still need to figure out what about the company would make me want to invest. Right? To me, if I say spinoffs outperform the market since or forever, it makes me feel like I may be focusing on trading. But if I want to hold this company for a very long time, then I need to figure out exactly what they're worth to me. Now they have a 3.97% dividend. Okay, 3.97% dividend. Now we're kind of building up worth here, just from an analytical perspective. But we're gonna be doing the same thing we did last time, right? So pretty much we had a base rate of what was that? 15.5%, right? That was our base rate. But we know the company has a negative beta. All right. So I'm gonna go with the base rate plus 3, so it's 18.5%. Okay? That's 18.5%. So now I need to figure out what the average analyst believes the company's worth. Let's go to stock analysis. Let's go to SFD. Okay. Let's go to the forecast tab right there. So $31.36. What was the highest high this stock hit in the past year? $29.81. Oh, that's interesting. What's our value on that? $29.87 is the street value here. Right? $29.87. So you can see another instance here where our valuations are pretty much on point. And, you know, I usually just go down the list, you know. I'm not going to try to do too much picking and choosing, but I'll skip financials for now, and I always come back to financials later. In fact, I think in our next session, I want to talk about in our next session, I want to talk about how to analyze bank stocks. Because you can't do those the same way that you do a normal company. All right. So screen the market. Screen the market. Figure out what you have interest in. Are you interested in growth right now? Are you interested in value right now? What are you interested in? If I say that I'm interested in value, what I'm saying is that I kind of want the stocks that people are not quite in favor of yet, because essentially my goal is to get that company at a discount if it's at a discount. Right? If it's not at a discount, we move on. All right. So scan the market, screen the market, get only the companies in front of you that you want to look at, that you would want to look at, and in any case. All right. And then once you get those companies in front of you, you sort them out, price to free cash flow. You can use other valuation metrics as well. You can use price to book, whatever you want to use. Right? But my go-to is price to free cash flow, because a low price to free cash flow outperforms every other metric. A low price to free cash flow outperforms price to book. A low price to free cash flow outperforms price to earnings, and so on and so forth. Okay? So once I figure out the companies I want to look at, right? I can do a little deep dive into them fundamentally, but also at the same time, you want to make sure that you're analyzing the companies from a qualitative perspective as well. Understanding the company, understanding what they do, understanding what they're about, what problems do they solve for the world? What problems do they solve for their customers? Right? And how would they go about gaining market share from their best competitors, from the top competitors? All right. So answer little questions like that, it starts to matter. All right. Now, I'm ready to start walking through this process again. So if anybody has any questions or anything like that, You can talk to us now. Does any questions come to anybody's mind? All right, now, okay, so hold on one second. Prince? Hey, what's up there? Somebody had a question. It's Twitch. Twitch, hold on, my bad. Let me see. Is the screen website free? Yeah, the screen website is free. Screen website is free. You don't have to pay for that ever. All right. You can always use that anytime you want, free of charge. All right. Everything that I'm going to teach you here is going to be free of charge for you to do. Um, like especially if you don't mind, putting in the work, doing the numbers. Is that analyst price the same as the street price? No, 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 no. That's a discounted price. That is a discounted price. So like I said, that particular price we would have discounted, right, by 18.5%. So let's go to SFD real quick. So to SFD real quick here. All right. They have the analyst target right here. You can also go to stock analysis, go to forecast, and $31.36. So remember, what I like to do is take that opportunity cost that we have. All right. So let's bring this back up again. Let's go to the spreadsheet now. All right, here we go. All right, let's zoom on in here. So this is what we were looking like, right? So for those that don't know how to set up a discount rate, like how much am I supposed to discount a stock by? All right, keep it really simple. All right, you would say, well, what am I missing out on? All right, what am I missing out on? Is that SDF or SFD? SFD. All right, what am I missing out on when I invest in something? So anytime you invest in something, guys, I want you to make a note that anytime you invest in something, you are um yes, the street price is discounted from the analyst target. All right. But anytime you invest in something, you're giving up something else. No matter what. No matter what, anytime you invest in one thing, you're giving up another. All right. So for example, if you know, I'm gonna talk about it from a simpler perspective, right? So let's imagine I have let's imagine I have maybe like 5 to 10 stocks in my portfolio. And I'm thinking, man, I need to make one or two new investments, and I have two investments in front of me. All right. So if I have two investments in front of me, if I invest in both, right, the opportunity cost still out there. I could have invested in the SP 500 instead. All right. Now, if I pick one of those stocks over the other, the immediate opportunity cost is going to be whatever returns that other stock is going to get. Now, sometimes opportunity cost is positive, and that means that you did give something up in excess. And other times, the opportunity cost is negligible, right? It doesn't matter because it's not higher than the return you got anyway, or what you got in return, right? So it doesn't matter what the other stock's price is. So um, I could have two stocks in front of me. One's worth $100, the other's worth $10. Right? Somebody may say, "Oh, I'm buying one that's $10." Okay. What if the one that's $10 only has, let's say, $1 in earnings? Right. But the company that has $100, or is trading at 100 multiple. Imagine that company, you know, um, is giving up $33. Right. So the multiple on the first company is a 10. The multiple on this company is a 3. Um, and so yeah, so they're trading at $100, but they're giving you $33 in earnings for it. So if all things are the same, then that's going to be the better company to invest in. All right. Now, okay. So the opportunity cost, we usually just pin it to the SP 500. So you can see here, right? Average return of the stock market, average return of the market, right? We're going to count that as your opportunity cost. Your 3136 is your see here, it's your forecast. Okay. Inflation at 2%, risk premiums at 3%. So basically we're saying the company owes me at least 13.5%. Plus, on top of that, I got to give up 2% for inflation. So I'm gonna add that to their bill. All right. Um, and then you have that risk premium, or that beta that really shifts things from there, just to give you an idea of what you know, um, you're expecting out of a company over the long run. Now, um, let's do the math here. All right. So this particular company has a beta, minus 5.5. Let me just show you guys what that looks like. Okay. This is what that looks like here. Right. It wouldn't make any sense to try to would make any sense to try to use this here. Okay. So what we want to do, right, is just focus on this particular aspect right here. Let's see here. Okay, there we go. All right. So all in all, if I was to just discount the stock by the 18.5%, that if I would have discounted it by the 18.5% that I got originally, then the company's worth about $25. We just move this out of the way for now. Let's get that out of the way. All right, they're worth about $25. All right, $25.50 to be exact. So it's one thing I found them, kind of middle of the pack in terms of valuations. When I dig deeper into them, I find though that I'm about to overpay for the stock, despite them having lower valuations. So the point of me going over this again tonight is because I don't want you guys to be mistaken here. I don't want you to be mistaken in thinking that if and let's go back over here to the stock real quick here, right? They're trading at $26.77. Okay. So I don't want you guys to be mistaken here in thinking that once a stock makes it to the original screener and once the stock is proving to be, trading at a low price, that means that they're automatically at a discount. All right. That part is not the case. And that's why this discounting part is so important. For those that have been around me a long time, I have a little saying to them. I tell them, the least you can do for yourself is discount everything. That's the least you can do for yourself. Right? If you're not the best at understanding, um, business models, if you're not the best at, figuring out what the best ideas are, if you're not the best at listening to a company talk about themselves and determining whether or not what they're saying is true or not, if you're not the best at that, be the best at discounting, guys. All right? I repeat, if you're not the best at those other elements, the qualitative reasoning and just kind of using your logic to determine whether or not something is a positive idea to invest in. I think in the long run, um, if you discount well enough, and if you discount everything you plan on touching, right? I can assure you that you will do a lot better than 90% of the people that participate in this market, because most of them are discounting nothing. And luck doesn't really cut it in the stock market. Yes, you'll be lucky sometimes if you were to just buy the stocks that you feel are good, and feel are good, right? Had my Oliver Velez moment. But Duran, I'm sorry, that was for Jared, my bad. Um, so yeah, yeah, but I would prefer to be, if anything, if I had one thing I could choose, that I can only do this. I can only do this one thing. I can't do anything else. It would be discounting. Right? That'd be the one thing. If I can't do anything else, if they told me, Deron, you can only pick one thing to do, what is it going to be? I'd say I'm going to pick discounting. Screw everything else. I'm going with discounting. Right? Because I know I stand a better chance. Right? The valuation multiples are great. They're amazing. Right? They allow me to get a glimpse at what might be. Right? Let's go back over here for a second now. Let's talk about what I was talking about earlier, right? Um, so this basket right here, this 16 to 25 basket that I was talking about earlier, right? 16 to 25 is the growth at a reasonable price basket. What I'm saying pretty much is that somebody in this basket, somebody in this bucket, they have a growth story that nobody's paying attention to yet. Y'all understand what I'm saying? I'm gonna say it again. Somebody in this basket, this screener that I just put together. Let me hit all the filters here for you guys so you can see it. All right, let me hit all filters. Where's it at? These are all the filters I use here. Okay, so all the filters. 1, 2, 3, 4, 5. Somebody, some company in this group, 16 to 25 out of these 750 companies, out of these 40 pages, somebody in that group has a better growth story than the market's giving them credit for. Somebody in there, they got it. I promise you that. That before you know it, they won't be in the 16 to 25 group. They'll be in the 31 to 40 group. Because the market, once it realizes that your growth story is better than they thought it was, they bump you up. What do we say we're looking to do? We're looking to find stocks down here at 16 that belong up here at 30. That's what we're trying to figure out. That company on page 16 that could be a company on page 30, which means the market could be paying more for this stock. That's all it means. All right. Let's take a look at another company then. If nobody has any questions, let's do another name here real quick here. All right. So all right, let's do Eat Brinker. All right. Now again, I showed you guys that benchmarking one because that's just, but I like to go straight to the pivot indicator. Let's get straight over there. All right, that was Eat, right? Let's go to Eat. Let's go to Eat. All right. Strong buy, exceptional outlook. No, and you're gonna notice something about the screeners that we put together. They truly deliver a lot of names that are, just pristine companies. All right. But I can assure you, Eat was not in that list. The last time we looked at this list, they were not there. And I don't believe that they might have just been let in just because of the, what I have in my hand right now. All right. Now, Eat has a F score of an 8. This means that 8 out of the 9 components that the Petrosky F score tracks have improved year over year. So they had a 88% improvement, out of 99% pretty much. All right. So not bad. And if it's not improving, it's either staying the same or it's getting worse. All right. Now, why don't we go and start digging for the one that's getting worse? All right. Because that's really not necessary. You have all these other numbers here for a reason. They all tell a similar story. Right? To the stuff that you may find trying to dig to see which part of the F score fails. Right? You price the book. Here we are again. Price the book a little too high, but this time, you have your return on invested capital. This time you have your return on invested capital. Return on invested capital is like saying, what's the return that they're getting on the money that we reinvest into the company, pretty much, right? What's left of that, right? What's being created in excess. All right, now everything else seems to be on point. Earnings are up 40%, sales up double digits as well. So I don't see any major red flags here in the numbers. But also not the type of company I'm looking for right now. Either way, let's double check our discount here. 159.32. That's the price that they're currently trading at. All right. So EAT. All right, $1.84. That's what they're supposed to be worth. Okay. So now let's grab all the things we need. Their beta is a 1.28. Sorry, 1 second. All right, so their beta is a 1.28 now. All right. And their price forecast is $184.90. Now, I built this little tool that I'm using. It's just a spreadsheet. It's no big a deal, right? But I use it as a visual aid so that way you guys can see, how how this company looks right now. So in the end, they needed to be discounted by an average of about 19%, pretty much. And that put us at around 150 to 184.90. So maybe they are at a deep discount right now. We checked the valuations, and that's all good. So now this one would make a little more sense if if it was for me, if it's something I would invest in. But like I said, for now it's just an example, just a way to give you guys an idea. So as I said, your discount rate. There's many ways to calculate that. One of those ways of calculating it is called the cost of equity. I do use that a lot. It's a little more complex. It requires you to go hunting down, you know, uh, current treasury rates and stuff like that. And you don't want to have to do all that. All right. So, anyways, um, that's pretty much it for tonight. Um, we're gonna Discounting is gonna be coming up in a lot of the sessions. All right, it's gonna be coming up in a lot of the sessions. But tonight wasn't all about discounting. Tonight was about valuation strategies, right? So on the first side of things, we talked about the relative valuation. So I can compare a company to their industry, like we did with SDF. And in the end, if I find one, I find one. If I don't, well, I know exactly where to go to find the other groups of company and the other companies in the group because maybe they're doing better, right? Now, we talked about my favorite is the style segmentation, which takes the market and splits it into these different groups. And what I like to do, this is how you get the best out of the discounting thing, right? I pretty much say to myself, you know, I cannot invest in this. I cannot invest in that. Right. For example, I cannot invest in the highest valuation group. I cannot. That's a mandate. I cannot invest in the highest valuation group. So a lot of people will start at the lowest valuation group and start to work their way up. And all along they're looking for that first valuation group they haven't really caught on yet. You know, but in the end, this ends up being the easiest way to do it. So again, you're just kind of sorting the companies out, right? You're saying if I have 20 companies, I could split them into four groups, the lowest valuations on the in the first group, the highest valuation into the fourth group, and then groups 3, 2, and 3. Those are the groups I can invest in. Okay, so I want you guys to really practice this weekend. Practice your discounting this weekend. Tomorrow morning, if you are a subscriber on the Twitch, tomorrow at 11 a.m., I'm gonna do a short discounting session. Okay, I'm gonna do a short discounting session, subscriber only. All right. And I'm gonna just kind of give you guys an opportunity to just kind of take advantage of that time to learn some of these different methods. Okay. So a little extra work. I'll be on for maybe like an hour to 90 minutes, and I'll show you guys some more of that discounting. All right. Other than that, doesn't seem like there's many questions tonight. Oh, Cecily, go ahead.
Yeah, can you do me a favor? Can you bring back up that spreadsheet? And can you do Smithfield and Symphony again? Because I swore for beta you had -5.5 and it should be -0.55.
Well, it won't matter.
It doesn't matter.
Yeah, no, it's a negative. So
So
you would just not you would just not use it.
just
Yeah, you would just not use it because you can't use a negative beta in this and in these
this one.
yeah. Yeah, I was really just filling it out just to fill it out just to show what would happen.
What it looks like. Okay.
Yeah. All right. So again, so for those that are sub to the channel, I'll see y'all in the morning. For the rest of you guys, I'll see some of y'all later on Saturday, some of you guys on Sunday, and for the rest of you guys, I will see y'all on Monday morning, where we're gonna see how this market plays out from here, because for the first time in a while, that for the first time in a while that statistical edge on the T triple Q is actually below the average edge of the wins. So we're gonna see how that plays out. Um, and you know what? I might do a little extended session tomorrow where I talk a little bit about the new pulpit fit indicator and give you guys a new a new map out of that as well. So you know we'll probably talk about it. We'll probably talk about it. All right, guys.
11 a.m. Eastern.
11 a.m. Eastern. Yes, 11 a.m. Eastern. I'll talk to you guys then. All right. Everybody be blessed. Stay well. And I will talk to you soon. Later.
Thank you.